Right. Good morning. Welcome to today's session. Right. Today's session, we're going to do introduction to company accounts. Then on Tuesday, we're going to start on cash flow statements. On Tuesday, we're going to start on cash flow statements, which will be, I think, a major part of your next assessments. Right. So today we'll do a company. You don't do company accounts in your module. You actually do just an introduction to company accounts. You just do an introduction to company accounts, right? Before I move on to the questions that I gave you, I just want to give you a few background to these things that we'll be doing, right? We know that we have dealt with the sole trader, we've dealt with the partnership, we've dealt with the close cooperation. Now, a company is an entity that is registered in terms of the Companies Act 71 of 2008. It's an entity registered or incorporated in terms of the Companies Act 71 of 2008. Now, a company allows a business to raise more capital. I think you know that you as an individual, you can have limited capital. Even if you take your friends and form a partnership, still your capital might be limited. So to structure a new form of business whereby maybe even people who are not known to each other could come together and invest in one company. But you know that there are trust issues. I cannot just invest with someone whom I don't know today. But the Companies Act provides a protected form of entity whereby even unknown people can easily invest within that company and have their investments protected form of business that we have. So you'd find that this company provides that option. Right now, the capital of an option is divided into smaller proportions, which we call shares. The capital of a company is divided into smaller proportions, which we call shares. If you want to become a part owner of a company, you buy some of these shares. Right? We've got different classes of shares. We have got preference shares. We have got ordinary shares. Right? The owners of the company are the ordinary shareholders because these are the ones that will have voting rights. Decisions in a company are made through votes. So the more shares you have, the more votes you have. So if you want to have power in a company, you buy a lot of shares. If you buy more than 50%, whatever you want, as long as it's permitted according to law, can be done in that company. Right. So ordinary shareholders are the owners of their company and they exercise their voting rights when making decisions. And usually they are the ones who are responsible for appointing the board of directors. A company is run by a group called the board of directors. Right. The ordinary shareholders, they also do not have a fixed dividend. Right. What is a dividend? A dividend is the share of profit that is given to shareholders. At the end of the year, the business will check what are the profits that we have, what is the cash that is available. If there is cash and there are retained earnings, then they can pay a dividend to the shareholders. Right. The ordinary shareholders, they don't have a fixed dividend. So they don't even.
Sorry, man. I just want to know if you're projecting anything.
No, I'm just describing, like I'm just giving
okay,
an overview.
Okay, no, that's fine. That's fine.
Yes, sir. Right. So I just want to give you a background because I could have done writing, but it might take time and I will not be able to do the questions that I want. So I'm just giving you a background so that when I do the questions, you'll have an idea of what we're talking about. Right. So we're saying the ordinary shareholders, they don't know what they are going to get at the end of the day. They don't know the dividend that they will get. It will depend on the performance of the company. If the company is doing well, you are likely to get a very good dividend. If the company is not doing well, you get a smaller dividend. There's what you call an interim dividend and the final dividend. An interim dividend is paid during the year, whilst a final dividend is paid at the end of the year. Right. And also ordinary shareholders, if things get tough and the business has to close, they will be repaid their money at the end after all other stakeholders. And in terms of dividends, they will be paid dividends last after all other claims have been paid. So it's risky to be an ordinary shareholder, but at the same time, if the company is doing well, the ordinary shareholders are the ones that get the highest return. Right, then after ordinary shares, we've got what we call preference shares. Preference shares, from the word preference, they've got a preference over the ordinary shareholders. Right, the preference shareholders, normally they don't have voting rights unless there are special concessions that give them voting rights, but normally they don't have voting rights. They don't vote in the decision making, but they receive their dividend before ordinary shareholders. Ordinary shareholders cannot be paid a dividend before we pay preference shareholders. So at the end of the day, if we are doing a question and the question says the company declared an ordinary dividend, it also automatically means that they've paid a preference dividend, because according to law, they cannot pay an ordinary dividend without paying a preference dividend. And also, when the company is closing, the preference shareholders are repaid first before ordinary shareholders. Normally, we start with the creditors. After the creditors, then we pay the preference shareholders. Then after the preference shareholders, then we pay them ordinary shareholders. And the preference shareholders normally have a fixed rate of dividend, which is expressed as a percentage. For example, 10%. So that will mean that they receive 10% of their money every year. Right, on the preference shares, we have two classes. We have got cumulative and non-cumulative preference shares. Right, with cumulative preference shares, it can happen that in a particular year things are bad and a dividend is not given. And the next year, if things improve, the cumulative preference shareholders will receive their dividend for 2 years. That is last year, the one that they did not get their money, and this year. So when you say cumulative, that means whatever dividend you forgo in a particular year, you will receive it in future. But non-cumulative preference shares, it means that whatever dividend that you had forgone because things were bad, you will never recover it in future. That is the end of it. Right, so you should be able to know which dividends are we dealing with, which shares are we dealing with. And also, a preference dividend is paid pro rata. That means if you buy your shares in October, at the beginning of October, and our year is ending in December, and they declare a dividend, you only receive a dividend equivalent to 3 months dividend, not a full year's dividend. But for ordinary shareholders, they are not prorated. Even if you buy on the 20th of December and the dividend is declared on 31 December, they usually use a date that all shareholders in the asset register by this date, they will get the same dividend regardless of when the shares were bought. Right. So normally we have to make a record. The questions that we normally have are asked in our module are the questions to record the issue of shares, and also the questions to record the declaration of a dividend. Normally, you are asked either in the form of calculating or in the form of doing journal entries. So we want to do journal entries using questions on companies. Right. And you should also know that the advantages of forming a company. A company is a person at law on its own. It's a separate legal person. So if you form a company, you will not lose your personal property if the business fails. Remember, in a sole trader and a partnership, if the business fails, there is unlimited liability. They can even come and take your personal other property, which has nothing to do with the business, to cover for your debts. But in a company, if the things do not go well, you only stand to lose the investment. And also, there is no managerial burden as there is separation of ownership and control. The owners are the shareholders, the managers are the board of directors. So you can just invest money and relax, buy shares and relax at home. And there's also what we call continuity, in that if a shareholder dies or leaves, I think you saw when we're doing partnership, we said that if a partner leaves, then the old partnership ceases to exist and we now have a new partnership. But when it comes to a company, shareholders, they can come and go and it will still remain the same company. And at law, it's a person which can sue and can be sued. And you should understand that a company is a separate taxpayer from its shareholders. It pays tax as a business on its own. tax is normally 28%. Right. So that's the general background to a company. So now today we'll be focusing on recording transactions to do with the issue of shares and the calculation of dividends. So I'll be using the document that I gave to you earlier on. I sent to you. Right. Don't worry about branches. This question mixes branches and company accounts. So our focus is only on question 1 and question 2. Right. Question 1. On 1 October 2016, Home Music Limited was registered with an authorized share capital of 500,000 ordinary shares, and the founders of the company subscribed to 20% of the shares at R1 per share. All the shares offered were taken up and paid for on 2 October 2016. Right. There's what we call authorized share capital and issued share capital. Authorized share capital refers to the maximum number of shares that a company is permitted to issue according to the memorandum of incorporation. Actually, when you register a company, you file what is called a memorandum of incorporation. It will state the general things about your company. Even the rules and the procedures regarding that company will be included in the memorandum of incorporation. Right. So the authorized share capital is the maximum number of shares that you are permitted to issue. So we don't make any record about the authorized share capital. Right. Then the founders of the company subscribed to 20% of the shares. Right. Our question is, record all the transactions pertaining to the issue of the shares in the General Journal of Music, Home Music Limited, for the period 1 October 2016 to 15 September 2017. Narratives are not required. Right. Let me just open my Excel sheet. All right, it's open. So some of the things that I was saying, I will be repeating them as we go. So we have an introduction, company financial statements. Question 1. Right. Some of the notes that I'm writing here, please note that they are not part of the answer, but they are just for you to get assisted. Right. So to understand, authorized share capital refers to the maximum number of shares. That the company is permitted to issue. As stated in the memorandum of incorporation. Then the issued share capital is the actual number of shares issued by the company. Right. You might find that the shares the authorized may be for 1 million, but maybe when we start, we only need 300,000. So we only issue for 300,000. Then when we need more capital in future, we issue more shares on and on. So the shares in a company are issued in phases. Right. We record journals for issued share capital. and not authorized share capital. So we don't do journals for authorized share capital. We do for the issued share capital. So the authorized is just there. Normally we just disclose it in the financial statements to just show the user that the maximum number of shares the company is permitted to issue is so much. Right. Now when you are doing journal entries, it's your normal journal from your 1502. That means we're going to have debits and credits. Right. So all the time that a transaction happens regarding the issues, we have to make a record. Right. Like in this case, I think we are told that on the first day there, let me just go back to the question. Right. On 1 October 2016, GOM Music Limited was registered with an authorized share capital of 500,000 ordinary shares, and the founders of the company subscribed to 20% of these shares at R1 per share. All the shares offered were taken up and paid for on 2 October 2016. So we have to make a record on 2 October 2016 when these subscribers right. So we have to do a calculation. To October issue incorporators. Right. Number of shares issued would be equal to, right? We are told that the shares that were issued to these guys is 20% of the shares. And we know that the shares are 500,000. So say 20% of 500,000. We get what? 100,000. Right. Now in our journals, we don't record the number of shares. We need the value of the shares. We need the value of the shares. That is the amount. Now we are told that these were issued at R1 each. So we'd say value of the shares. These are 100,000 multiplied by 1 rand, which is equal to what? 100,000 worth of shares. Right. So when we do our journal entry, there are two accounts that are affected. Number one, we've got bank, since these incorporators are going to pay for these shares. Right. So the business, the company, GOM Music, is going to receive money. So when they receive money, their bank, which is an asset, goes up. And when an asset goes up from our 1502, we know that it has to be debited. So our bank will be debited with 100,000 because bank and asset is increasing since the business is receiving this money. Then what is this money for? It's capital. Capital is equity. When equity increases, we credit. So we're going to credit the incorporators for that money. Ordinary shares. $100,000. Let me just see when were these shares allotted? Right. So here this will be recording the payment. A recording of payment for shares by the incorporators. My friends, when they say that narrations are not required, they mean this description here in this question, it was not required, but I'm just showing you. Right. Then, so when they pay the money, it goes to the incorporators, the account, we open an account in incorporators ordinary shares, which is a liability. Then when we give them the shares, we then debit that incorporators ordinary shares. Create that liability, which is 100,000, and then we credit share capital. I want to explain this so that you can, I think in the beginning, I just combined the two. Right, the first entry is to record the receipt of money from the incorporators. Now we'll record it as a liability because we're owing the money because they've paid, but we've not yet given them the shares. Then here will now be the allotment of shares paid for incorporators of the company. So the first year we're just receiving the money. Then when we give them the shares, we then credit share capital. That will be on 2 October. It can happen on different days, but here I've just used the 2 October because they said they were taken up and paid for. So that means everything happened on that day. Any questions on that? Right. Then on 15 August 2017, Home Music Limited offered 40% of the authorized share capital to the public at 250 per share and appointed Primary Bank as the underwriter of the share issue at a commission of 1%. By 1 September 2017, the closing date of the applications, 250,000 shares were applied for. On 15 September, all of the offered shares were allotted by the board of directors, and all the direct transactions with the underwriter were concluded on that date. I want us to be careful here. Number one, when the shares are being sold, the company can sell directly, which may be difficult. So normally they would appoint an underwriter. It can be a finance company, insurance company that can sell the shares on their behalf. This is to make them more attractive. Honestly, if you hear that Eugenius Limited is buying shares, you might not be willing to just buy the shares. But if you hear that Absa is selling shares for Eugenius Limited, you might be willing more because you know that Absa cannot be associated with shady people or shady companies. So that's why they use an underwriter. And also an underwriter usually also guarantees, sometimes guarantees that any shares that are not bought, they will buy them. Right. So the first thing, let's follow these events properly. The first thing on 15 August, there was an offer of the shares to the public. When you are making an offer, you write up your prospectus and you advertise that you are selling shares. So when we say there's an offer, they are just advertising that they are selling shares. Right. So we should know that 15 August 2017, offer made to the public. No record is made. We don't make any records on the date that the offer is done. Is that right? So there are no journal entries that will be made on that date. Right. But then we then received applications. Okay, they issued 40% of the ordinary shares. Can we just calculate how many shares were being issued? Right. Shares offered on 15 August 2017. They said 40% of the authorized share capital, 40%, and we know that the authorized share capital is 500,000. So that means they were offering 200,000 shares. Right. Then there's a commission of 1% of the issue. Right, the shares are being issued at 250. Then on 1 September, the closing date for the applications, 250,000 shares were applied for. They applied for 250,000 shares. So we can say 1 September 2017. When they apply for the shares, we debit the bank because money is received. That is 200,000 shares times 250 per share. What do we get? No, sorry, the applications were for 250. So when you advertise, you might receive applications that are more than the shares that you're offering, or you might receive applications for less. What do we get? Hello? What do we get there?
$620.
It's what?
625,000. Is it 125?
125.
625.
I can't hear you.
625,000.
Okay.
Yeah.
Right. Right. Then we credit application and allotment. Receipts of application monies. Right. Then at the same time, we also account for the expense of the underwriters commission. Right. Our commission, you should know that our commission will only be on the shares that are being issued. Our commission will only be on the shares that are being issued, which is the 200,000. So it will be 200,000 times 250. We are told that the commission is 1%. What do we get?
R5,000.
It's what?
5,000.
Right. All right. Then we credit the name of the company, that is Premier Bank. It's a liability because we have not yet paid them. Accounting for underwriters commission. Right. So that's what will happen on that 1 September. Then on 15 September, all of the offer sheet were allotted by the board of directors, and all the transactions with the underwriter were concluded on that date. Right. So on 15 September, that's when they give them. On 1 September, they just paid. Then on 15 September 2017, that's when they are given the shares. When they are given the shares, we'll then debit the application and allotment. So application and allotment is the temporary account that just records the funds before the shares are issued to the shareholders. Right, but the application and allotment will only debit for the shares that were actually issued, because we're only going to give them the shares that we issued. Which is what? What do you get? What do we get there, guys? I'm waiting for you guys.
500,000.
500,000, thank you. Then we credit ordinary shares. So although they applied for 250 shares, we only give them the ones that we are offering right now. Right. Allotment of shares to successful applicants. Now they can be question, okay, so then what happens to the others? Remember, they applied for 250, but we're only offering 200. The other 50, they will get refunds. So we'll account for the refunds, application, and allotment. So if we receive more applications than what we're offering, the remainder will have a refund. So it will be 50,000 times 250. Where is my 50,000 coming from? That is the shares that we are offering 200, the difference between the shares we are offering 200 and those that are that were applied for 250. That's the 50,000. What do you get?
$125,000.
Right. Then we credit bank. That will be the refund of application monies and successful applicants. Right. Then on that same day, we were also told that and all the transactions with the underwriter were concluded. So we also pay the commission. When we pay the commission, we debit Premier Bank, this one here. To clear the liability, we debit Premier Bank with 5,000 and credit bank. That is payment to underwriter for commission. These will be the general entries that will have to be done. Any questions?
Sorry,
Right.
sorry, Eugene. You
Yes.
said we're giving Premier Bank 5,000 again.
Hello?
I'm saying you said we are giving Premier Bank 5,000 again, which we gave them.
Remember,
earlier.
here we didn't pay, we're just accounting for the commission. By crediting Premier Bank, we're recording a liability that we owe Premier Bank. The moment that they start the job, that's when we recognize the expense. So here we're recognizing the commission, we had not yet paid it. Now
Oh.
that's when we pay it.
From the bank.
Yes.
Okay, thank you.
So those were the transactions pertaining to the issue of shares that were supposed to be recorded. Right. Then the part B, calculate the dividends that were paid by Gqom Music on 2 October. Right. During a board meeting on 30 September, the directors declared a dividend of 20 cents per share. The dividends were paid on 2 October. So they were paid after all those transactions had taken place. Right. Right. Shares in issue. We know that to the incorporators at the beginning, we issued how many? Here, we issued 100,000. Then this was that we then issued were 200,000. So all in all, the shares in issue are 100,000 plus 200,000, which is equal to 300,000. So the dividends paid would be equal to, we are told that they paid 20 cents per share. So would say 0.20 multiplied by 300,000. What do you get?
$60,000.
60,000. Right. So those are the dividends paid. Any questions? If we don't have any questions, I'll move on to number 2. All right. Boima Limited was registered on 1 January 2015 with an authorized share capital consisting of 200,000 shares. The company offered 10,000 shares to the incorporators of the company at value of 20,000, all of which were taken up and paid for on 28 January 2015. All right. On 1 February 2015, the Boima Limited shares traded at 20% more than the previously recorded price, and the company decided to offer ordinary shares to the general public. This public offering was underwritten by Doomsday Bank at a commission of 4%, which had to be settled by 31 May 2015. The company's accounting records indicate an expense amounting to 6,000 as underwriter's commission. The shares to the public were issued and allotted on 28 May 2015. Then on 1 June 2015, Boima Limited received a check amounting to 36,000 from Doomsday Bank as final settlement. On 28 June 2015, the board of Boima Limited decided to issue capitalization shares to ordinary shareholders in the ratio of 3 ordinary shares for every 5 shares held at a fair consideration of 136,800. On this date, Boima Limited had a credit balance of 500,000 in the retained earnings account. Right. Calculate the number of shares that were subscribed by the general public before the capitalization issue. Right. They want us to calculate the shares that were issued here. If you can check, they are not telling us how many shares were issued. They are just saying on 1 February, the Boima Limited shares traded at 20% more than the previously recorded price. Right, what was the previously recorded price? If you come back here, the company offered 10,000 shares to the incorporators at a value of 20,000. So we can find the previously recorded price is 20,000 divided by 10,000. Okay, so we can say question 2. Calculation of shares issued to the public. Right. Previously recorded price would be equal to right. We're going to say 20,000 divided by 10. 10,000, which is equal to 2 rand per share. Then a price of public issue right. We are told that the public issue, the shares now traded at 20% more than the other price. So it's 20% more. So we will just add 20% to that previously recorded price, which is 2 times 1.2. Or if you want the long way, you can first calculate the 20% and then add. But to go straight to the value, you can just multiply by 1.2. What do we get? What do we get there?
2.4.
240. Okay. Right. So these shares were issued at 2 rand 40. Right. There's a commission of 4%. And we are told that they indicate that there was a commission of 6,000. So to get the total value of shares, if we are given the commission, would say underwriter commission divided by commission percentage. Right. Because if 6,000 is 4%, to get the total, we can simply divide. So that means we can say the underwriter's commission of 6,000 divided by 4%. What do we get?
$15,000.
Hello?
15,000.
15,000. Are you sure? Isn't it more than that?
Isn't you say 6,000?
Hello?
6,000 divided by 0.4. Oh,
Divide
sorry,
by
yes.
4%.
Yes, I see my mistake now. Divide by 0.04.
Yeah,
150,000.
0.04.
Yes, 150,000.
150, yes, I think that would be the final. So that is the value of the issue. So we know that each share was 240. So to get the number of shares would be equal to 150,000 divided by 240. So these are the total shares that were being issued. What do we get?
$2,500.
2,500 shares. So that means these are the shares that were being issued. These are the shares that were being issued. Right. But the question is saying, how many shares were subscribed by the general public? How many did they subscribe for? How many did the general public subscribe for? Right. You have to be very careful here. The total shares were 62,500. But Boima received a check amounting to 36,000 from Doomsday. Right. Remember, we are the ones supposed to be paying them 6,000, the commission here. But if you see your underwriter paying you, that means the share issue was undersubscribed. And some of the shares were taken by Doomsday. Right. So the value of shares taken by Doomsday will be equal to the 36 they paid us plus the 6,000 commission, which is equal to 42,000. That means they took up shares of 42,000. But then they only paid us 36 because we were owing them 6,000 for the commission. So that's why they paid us 36. Because the total amount was 42, then they withheld the 6,000 for the commission. Then they paid us 36. So we can be able to find the number of shares taken by Doomsday would be equal to 42,000 divided by 240. Remember that each share was 240. What do we get? What do we get?
17,500.
Is what?
17,500.
That means the shares subscribed by the public. Remember, we're offering 62,500. So if Doomsday took up 17,500, so that means the general public only subscribed for 45,000 shares. So we're offering 62,500, and the general public applied for 45,000. Doomsday it take up the remainder of the shares, which were 17,500. Is that fine? Right. So that is our answer to that. Then record the journal entries for the period 1 February to 30 June. Right. I will not start on 1 February. I will just start from the beginning. Right. Boima was registered on 1 January 2015 with an authorized share capital consisting of 200,000 ordinary shares. Remember, the authorized share capital, we don't record anything. Then the company offered 10,000 ordinary shares to the incorporators of the company at value of 20,000, of which all of which were taken up and paid for on 28 January 2015. Right. So this was not supposed to be recorded because they said from 1 January, but I'm just going to do it 28 January 2015. Debits, credits. Right. We first have 28 January 2015. We debit bank with the 20,000 were given that value, and credit incorporators of the company. I'm not going to put narrations now. I think I've shown you from the other ordinary shares. Right. Then when we issue them the shares, we debit then we credit right. So that is those will be our records on 28 January 2015. Then on 1 February, that's when they offered the shares to the public. Then the share issue was to be settled by 31 May. The company accounting records indicate an expense amounting to 4,000 of the commission. The shares to the public were issued and allotted on 28 May 2015. Okay, first of all, there's the application. We're not given the dates. I'll just say 1 February 2015. We debit our bank to receive the application monies. Remember, only 45,000 shares were applied for times 240. What do we get?
$108,000.
Then we credit application and allotment. Right. Then we also debit underwriters commission. $6,000. Then we credit Doomsday Bank. This one we're not paying them. We're just showing them that we are just showing that we owe them for the job that they are doing. Right. Then the allotment of the shares. The shares were issued and allotted on 28 May. So we'd say we'll debit application and allotment with 108,000. Then we'll debit Doomsday for their shares that we are allotting to them, which was 42,000. Then we credit share capital, ordinary shares. So by this, we are saying the other 108 is coming from these other shareholders. We received it from the public. Then the other 42 were saying we're debiting Doomsday because we're saying they are the ones taking up the shares. So we're debiting them, they become a debtor. They will now be owing us 42,000 for the shares that they are taking up. So if the issue is undersubscribed, the underwriter will take up the remaining shares. Right. So that's it on 28 May. Then on 1 June, Doomsday then settled the 36,000. The 36,000 is the 42 minus the 6. So now say on 1 June 2015, we'll debit the what? The bank, because we'll be receiving money from Doomsday. 36,000. Then we credit Doomsday so that they are settling their debt. When a debt is settled, we credit their account. 86,000. Right. Then on 28 June, the board of directors decided to issue a capitalization issue in the ratio of 3 shares for every 5 shares held at a fair consideration of 136,800. On this date, Boima Limited had a credit balance of 500 in the retained earnings. Right, a capitalization issue, this is an issue of shares to shareholders for free. The company can decide to issue shares to shareholders for free. That's a capitalization issue. So they are issuing these shares to the shareholders for free. So, but that amount is to come from retained earnings. It is taken from retained earnings. Right, so debit retained earnings. So for capitalization issue, they also call it a bonus issue. It's an issue of shares for free to the shareholders. So always you debit your retained earnings, and it can be only be issued if the retained earnings are enough to cover the bonus issue. Like in this case, the bonus issue requires 136,800, but the retained earnings balance is 500,000. Right. Then we credit share capital. Ordinary shares. 136,800. So that's how we record a capitalization or bonus issue. Any questions there? right? In some exams or tests, they might not tell you the value. They can just say they were issued at R2 each. First of all, you will have to calculate the number of shares. So you first have to find out how many shares were there in issue before this issue. So we know that there were 10,000, and here, remember, we calculated, we found that there were 62,500. So that means the shares that were there were 10,000 plus 62,500. The 62,500, remember, we calculated it on part A, which is equal to what? 72,500. So that means before the bonus issue, there were 72,500 shares. Right. And then we are told that they then issued 3 ordinary shares for every 5. So it's 3 over 5 times 72,500. What do we get?
$43,500.
43,500. So this will be the number of shares, but it was unnecessary here because when you're doing general entries, you don't necessarily need the number, you need the amount. So since we're given the amount, there was no need to do this. But I'm just showing you in case you might find a question that they don't give you the number of shares and you have to calculate them first. Then you then multiply by the price per share. They can give you the price per share. Then you multiply by the price per share. Any questions? All right, my friends, I think I didn't incorporate one thing that I also want you to go in your study guide and look at. Can you go in your study guide and look at the ordinary, the preference shares, the preference dividend? How we account for the issue of shares? If it's preference shares, it's exactly the same. Only that way we're saying ordinary will now be saying preference shares. Everything will be the same. The only thing that I want you to check is the calculation of the dividend for preference shares and whether they are cumulative or non-cumulative. That's where the difference is only when it comes to dividends. Otherwise, the general entries is exactly the same. The only difference is where we're saying ordinary shares will be saying preference shares. But the calculation of the dividend, there's a difference. I think we did the calculation of the ordinary dividend. So go in your study guide and check that. If possible, before I look at, if I'm able to remember, before I look at cash flow statements on Tuesday, maybe I can just find one example on that. Okay, thank you so much. Enjoy your weekend. So, ladies and gentlemen, those who are, let me just say.